I could use more of that in my life. Thank you. Good morning. I'm so excited to be here with all of you today. As mentioned, my name is Karen Houghton, and I am the CEO and founder of Infinite Giving. That means we are a registered investment advisor that serves exclusively nonprofits. So our job is to partner with nonprofit teams and their boards to make finances easier. And that's part of what we want to learn today, right? So, today we're going to be talking about the 3 financial practices that you need to have in place for a sustainable nonprofit. Now, if nonprofits were a country, did you know that we would have the 5th largest economy in the world? In fact, in the United States, nonprofits hold over $2 trillion in securities and savings. Now, you may be hearing that and being like, where's that money? I don't see that money. And I understand that, right? And it's dispersed sometimes unevenly. But what it does mean is that we have a responsibility with that kind of footprint, right? With that kind of footprint, we can't just raise money. We have to manage it. So I want you to raise your hand if you spend a huge majority of your time thinking about and planning how to fundraise money, right? That makes sense. You literally can't do your work unless you're fundraising money. So here's another question for you. How many of you spend a significant amount of your time planning for and managing the money you already have? Okay, some of you, good job. The discrepancy there is not uncommon, and that's kind of part of what we're going to talk about today, is how do finances and nonprofits work together, and how do we work on not just raising money, but deliberately spending time and having the tools we need to also manage it. Because stewarding what we have is important, because that is what creates resilience. And I think we can all agree that financial resilience leads to better outcomes for the people you serve. You can have an amazing organization, but if you can't pay your people, that means you're going to shut down. And then who's going to serve the people that you're called to serve? You can launch an amazing new program and have it go swimmingly well, but if 6 months later you can't fund it, have you created more harm than good? These are the questions that we have the burden and responsibility and honor of working through as a nonprofit. And how do we think about money, and how do we plan for sustainability? Because we all agree, again, financial resilience leads to better outcomes for the people you serve. This is part of your responsibility. So let's talk about the very first cornerstone. Financial resilience means having a healthy reserve fund. Today, we're going to define a reserve fund as funds in excess of the money that you are going to spend in the next 12 months, right? So it's not, oh yeah, I've got 6 months lead time in the bank, right? Reserves are above and beyond what you're going to spend. Think about it as an emergency fund, a rainy day fund, right? Just like you would for your personal finances, you have to plan for the what ifs. Pre-COVID, you would hear 3 to 6 months of operational expenses to have on hand was pretty standard. Post-COVID, it's 6 to 12 months. Why is that? Because we felt it for the first time, perhaps, right? The idea of, this is crazy, but what if a pandemic happened and our freezing and our donor and our money coming in just stopped? Right? Okay, we felt that. What if a grant that you had for the last 5 years all of a sudden didn't renew? What if a donor who committed and had committed every year that you knew they were going to give again, they did not give? This is why we have a reserve fund, and it's why the very cornerstone of being a sustainable nonprofit is to be able to have those funds. So maybe you have them, awesome. Maybe you don't, that's okay. Now you have a financial goal, right? Now the difference between 6 to 12 months, that's a big variable, right? Especially if you're a larger organization. There's no wrong or right answers. It is, what is your risk tolerance? How predictable is the revenue or the donations that you have coming in? So there's a lot of questions in that, but that's up for you and your board to decide. Once you have those reserve funds, then the question is, what do you do with those reserve funds? Please do not keep them in your checking account. What do you think happens when you keep reserve funds in a checking account? You spend it, right? That's humanity. We all do that. You do it in your personal finances. You're like, oh yeah, I've got some buffer. Oops, it's gone. And you don't always know why, right? Tell me I'm not the only one that does that, right? Okay. So when you have reserve funds, the best practice is that you want to take those funds and you want to put them somewhere else. You want to define them clearly, right? So it's not just, oh, we have excess funds. And this gets to be a nuance. But it's the idea of, no. We intentionally know we have 6 months of operational reserves. We're calling it a reserve fund, and we're going to put it over here. And our teams and the boards understand where it is and the only reasons we can tap into it, right? It's like, oh, we know it's here for an emergency, or if we need this, or this happens in worst case scenario. It's not meant for you to dip into every month. If you're dipping into your reserve funds every month, they're not really reserves. That's part of your operating capital, okay? So when you have those reserves, there we go. You need to put them separately in a place where you are earning money on money. This is where finances can get exciting, right? Because we're spending time, so much time, fundraising money. But what if I told you that by managing the money you already have, you are already starting to close the gap on the amount of money you need to fundraise? We don't think of it that way because we live in this scarcity mindset. But by managing it properly, you're actually helping yourself in your fundraising goals as well. In today's market, managing your reserves means making a minimum of 4%, right? Now, this number would change. Actually, as of today, I would say this should be a minimum of 5%, right? I was talking to a nonprofit the other day, pretty substantial, and they were so happy with their savings account with their bank. And I was like, that's great. I'm happy for you. Do you know what your rate is? They were like, no. I was like, great. They're like, but I see money every month. And I was like, that's a good feeling, right? And they were like, yeah. I was like, well, do me a favor and just go check what that rate is on those savings account. Because generally, banks are not meant for long-term savings, right? Do y'all know that? I see some nods. That's usually groundbreaking for some people. We think of banks as being safe, right? And oh, this is where it goes. So they had 2%. And I was like, good. That was good and a competitive rate 2 years ago. But what would you think if I told you that for some of our clients, we closed them at 5.23% in short-term treasury bills this week? They were like, over 5%, that's amazing. I was like, yes. Managing your funds and spending time and intentionality around that is really important. So have reserves. Make sure that you're putting them in a place that's safe, highly liquid, but that is making money for you. You want your money to make money, right? That's the easiest way to fundraise. Secondly, it's good banking health, right? FDIC insurance. Who knows what that is? Somebody tell me. Yes. So it's like an insurance, right, on your money, because banks fail. If y'all lived through 2008, you're like, oh, that was horrible, right? Banks failed. If you lived through this year, we had 3 major banks fail. That happens. It happens more than we think. So sometimes when we're like, oh, this is the safe place, because we tie emotions with money, right? And especially when you're a nonprofit, there's like this extra burden where it's like, these are donations. People are trusting us with this money. There's a responsibility, and there is. So FDIC insurance is really important to have. So FDIC insurance, who knows what the rate is? $250,000, okay? So if you have more money in a bank account than $250,000, it is likely not FDIC insured, which when or if the bank fails, you will lose that money. You could lose that money. Luckily, that didn't happen this time around. Okay, if you have a much larger kind of balance, you can have a sweep program. A sweep program is something that means like, hey, they can actually insure it up to $5 million, right? It depends on where you are, but usually sweep programs start like around $5 million, generally. Every bank's a little different. So there's a big gap between $250,000 and $5 million. So then you're like, all right, if I'm supposed to manage the money I currently have, yet you're telling me I got to do this and I got to do this, and what do I do? So it's just reducing your risk, right? I don't want you to panic about it. Like, we're fine, right? We'll be okay. But there is some, stewardship on knowing that, hey, okay, if it's over $250,000, how do I diversify and where do I put those funds? And then it becomes a good loop because you're like, okay, I want 4 to 5% plus in a low or no risk opportunity. Again, today's market, y'all, is a really special time for some of us, especially nonprofits. So you're going to do that, and by diversifying either into treasury bills or government money market, you're getting better rates, you're moving some of the money out of the bank, and you're allowing to have more FDIC insurance, right? Or you're holding your money with the government. They're the ones who make the money, so that's considered low risk too. Okay? So one more note on that for FDIC insurance is sometimes we think, okay, well, I'm with my bank, but I've got a money market, a savings, and a CD, so I'm good. It doesn't matter where all that money is. It still only covers $250,000. Okay? All right, so number one, what was number one? Do y'all remember? Can't just raise money, you have to manage it. Number two, ask for asset donations in addition to cash. 90% of wealth in the US is held in assets other than cash. Yet, most nonprofits only ask for cash. In fact, over 90% of nonprofits only ask for cash. So let's play this game. What do you think the average online cash gift is? $100? $50? $25? So the average online cash gift is $128. Not bad, right? That's pretty good. Cash is easy to process and track, right? It's what we know, it's what works. And when I say cash, I'm meaning credit, debit, checks. Some nonprofits, y'all, we are addicted to getting checks in the mail, and that's not how online giving is going, right? So we need to diversify into that. But here's where it gets interesting, and I call it the bucket problem. The big bucket is that stat I just told you about. The 90% of wealth in America is held in assets, not cash. Yet 90% of nonprofits are only asking for cash. That means we are only asking from the small bucket. So that means you're going to get smaller gifts, right? If I've got a whole lot of money and you're only asking me for cash, then I'll be like, all right, well, what's 10% of my small bucket? 5%, 20%, whatever people do. But if you're talking to me about my big bucket, okay, that gets interesting. 10% of that big bucket is a whole lot more money. So a lot of what we're going to be doing when we're talking about assets is we want to talk through them, but I want you to be able to work smarter, not harder. Because gifts of assets tend to be bigger than cash, much bigger. So let's look at some of these numbers. Who wants to guess the average stock gift? 5,000? It's a good guess. Anybody else want to throw out a number? 2,000. All right, ready for it? The average stock gift in the United States is $8,000. Average crypto gift, 25 cents, is that what you said? I mean, you know, they're not worth what they were. It's going to come back. 10,000. Yes. Move to the front. You're already in the front. All right, so average crypto gift is 10,000. Average donor advised fund grant is 12,000, and of course an average endowment is 25,000 plus. So, remember the buckets, right? So if you are asking for cash only with an average of $128, to get the amount of donors you need to equal one stock gift, it's 62 donors. So do you want to build relationships with 62 donors? Or do you want to build a relationship with one high-capacity donor? The answer is you want to do both, right? But if you're only asking for cash and you're not thinking about assets, all of a sudden, you're working really hard with a lot of people and you're forgetting about that big bucket that you have access to. So we're going to talk about assets. These fundraising opportunities massively untapped, especially by small to mid-sized nonprofits. All right, we talked about crypto. It is worth more than 25 cents, right? Here's what's interesting, right? We're talking about Bitcoin, Ethereum, it's digital money. Doesn't matter if you don't believe in it or not, it's a thing. It doesn't matter if you don't understand it or not, it's still a thing. Here's what matters to you as a nonprofit. Fidelity Charitable did a study that said crypto investors are more likely to make charitable contributions than the average population. That's important, right? Average crypto gifts, $10,000. Okay, they're going to be more charitable, yet 95% of nonprofits don't understand crypto and don't make it easy for their donors to give to them. So here's the question I get. But is it legal? The answer is yes, okay? What you may not know is the IRS treats cryptocurrency just like stocks, right? It's an asset. And what that means is it is tax efficient and a great way for donors to give. If they can give you crypto, they're not paying capital gains taxes. You're getting a larger gift. So they're saving on taxes, it is legal, it's a philanthropic community. So it's a win for you and for them, yet why aren't we doing it? Here's the other question I get. Well, crypto's an outlier, right? Yes and no, okay? 21 million people in the United States own cryptocurrency, and $330 million was given to philanthropy in crypto last year. So it's out there. I always tell people it's not a silver bullet. You're not going to all of a sudden say, great, we're going to receive crypto, and maybe you will, but you're not likely to just get $1 million overnight, right? But what it is it becomes a strategy. And it becomes a strategy because you need to understand that it's out there, donors want to give it, and it's meaningful for them and for you. So the question is, what do you do with crypto? Don't buy it. Don't hold it, okay? It's still very volatile. But what you do need to do is make it an opportunity for your nonprofit. When you receive it, you liquidate it into cash immediately. There's a lot of different folks out there who can help you do that. And then you use it for good. It is not something you need to be scared of. So after crypto, we're gonna go to stock donations, right? Tesla shares, Apple shares, Coca-Cola, right? So you wanna receive stocks. Stocks are the most tax-efficient way for high-capacity donors to give. You wanna reduce friction for your donors, right? So again, if you're saying, yeah, you have stocks, but I really just want you to give it as cash. Here's what you're asking your donor to do. They have to go sell the stocks. They're gonna pay capital gains taxes. That means right there, by you asking that, you've lost 20 to 25% of your gift. You've created work for your donor, and then you get whatever money is left. Excuse me. All right, but if you receive stocks, they're saving on taxes. Yeah, I'll get some in a minute, thank you. You're saving on taxes, okay? It's the most tax-efficient way to give, and then you're getting a larger gift. So they're not paying capital gains, Uncle Sam's not getting their cut. That means you're getting more, you're making it easier for your donor, and then they get a bigger tax deduction too. So it's a double dip for them, and it's a win for you, which is really meaningful. Dr. Russell James did a study that showed that asking for stock gifts in addition to cash can increase contributions by 55%. This is data, right? So this is not my opinion. Imagine doubling your budget in 5 years by making the donations of assets a greater priority. And that's what this study showed. Again, it's not overnight, but it's a strategy. And it's a strategy over a 5-year period. They showed that it increased by 55%. Is that worth your time? Is that worth not just thinking about raising money, but how you want to do it and how you can manage it? Yeah, we don't do it. So today's your opportunity. All right, lastly, in the assets, we're going to talk about donor-advised funds, DAFs. So a donor-advised fund, giving account established at a public charity. Donors contribute to the fund. They get an immediate tax break. It's awesome for them. And then they request grants over time to their favorite organizations. We hear a lot about DAFs. You want to know why you hear a lot about DAFs? There's more than 1.2 million DAF accounts in the United States that hold $140 billion. It's a lot of money. So then what happens for nonprofits, right, is then we're sitting there saying, yay, how do we get that money, right? This is a thing. There's a lot of money sitting in there. So it's really hard to do all three things with his hands with these water. I should ask for a table. I was like, I don't need a table. Okay, are DAFs regulated? No. Here's who loves donor-advised funds. High-capacity donors, right? Because they can get money in, they get a tax deduction, and then they can decide when they're ready, when and what they want to give. Who else loves donor-advised funds? Why do you love them? So she's talking about access to the data behind the donor-advised funds, right? Yes. Okay, the other person who loves, you raise your hand? Yeah, go ahead.
There's also, sometimes like donations from donor-advised funds that you've never even heard of.
Yeah.
Just the exposure of learning about potential, ongoing.
Right? These are all great conversations that we have around DAFs. They're fairly new. It's like, oh, there's a lot of data in there. People know people. Sometimes when we get money from donor advised funds, it just like shows up in a check and we're like, that's fine, that feels good. Here's my thing with DAFs that I think nonprofits don't always understand that I like to point out, is there is no regulation on them and there is no guarantee when or if you will ever get money. So what you have to remember is that donor puts money in there and they lose all responsibility and authority over those funds. So whoever's holding that money, right, there's community foundations, NCF, like there's over 300 DAF providers in the United States who hold all this money. Do them or the donors, like neither of those parties have any urgency to give out that money. It's not regulated. It could be in 100 years. And I'm hearing a lot of nonprofits, and they're like, oh yes, I want to do a white labeled DAF, and we're gonna do that. Mostly because they want the data, which is smart, right? So they're not bad things. But I think what we misunderstand sometimes is that you think that money is gonna come to you. It won't. I could have an XYZ nonprofit DAF and never give $1 of that to your organization, right? And not only that, but even if as a donor I put money in that DAF and it becomes inactive, or a nonprofit has money in a DAF, and that person holding the money can change their mind and say, you know what, you're not doing that mission, we're gonna not let you have access to those funds. So just remember, they're not regulated, but we gotta access it, and they're important, because it's $140 million, right? So what we're gonna do is ask for DAF grants. It's not that hard, but if it's not a part of your conversation and education with donors, then you're missing out. Does anybody remember what the average DAF grant size was? It was $12,000. So there's a lot of money in there, and we're not talking about it. So for DAFs, just like any of these assets, you have to ask for them. It should be a very intentional, strategic part of your strategy and your fundraising. Make them all giving options. It should be a part of your conversation with any high-capacity donor. They should all be on your website. You should be talking about this. You have to educate your donors. Did you know that it's the most tax-efficient way to give? Or, hey, do you have a donor-advised fund? You may not have thought about giving a grant to us from there, but here, go here, and here's where this money could go, and here's how we make a difference. I encourage you to ask for stocks, crypto, and donor-advised fund grants. And again, of course, make it easy. Sometimes here we get the chicken and the egg problem, where I talk to nonprofits and they're like, yeah, that's great, that sounds really nice, but I don't get any of these. No one talks to me about these. Okay. Could it be that you're not getting them because you're not asking for them? Could it be that you're not talking about it? You're not educating your donors? Remember, those studies that showed a 55% increase happened over 5 years. So it is an intentional conversation, strategy that you're having as you fundraise and as you manage your funds to think, this is something that we need to do. We need to ask for assets, and we need to make it easy for our donors, educate them, and repeat the process, okay? Study of 1 million plus nonprofit tax returns. Those who pursued asset gifts instead of just cash, again, brought in 2 times the revenue 5 years later. I'm really making sure y'all get this, right? So what you need to do when you think about assets is ask yourself, is giving cash best for my high-capacity donors, and is it best for us? The data would say you should not only do cash, but you should also educate yourself and your donors and give them asset opportunities. All right, we're at number 3. Okay, so number 1 was you have to not just raise money, you have to manage it. Number 2 was ask for assets. Ooh, you guys are good. Okay, so third and final one, we have to move from a scarcity mindset to an abundance mindset. This is where things can get uncomfortable, right? We're nonprofits. You're like, no, I got money in, we got money out, we're doing good work. I can't sit on money, right? That's what we would call a scarcity mindset, when you don't know where you're gonna be next month. You're like, hey, I've planned for this project, so I got the money in, I got the money out. An abundance mindset gets you out of that hamster wheel, right? And it allows you to step back and plan really intentionally about, all right, if we have this vision, what is not only our 30-day, 60-day, 90-day vision, but what is our 1-year, 3-year, 5-year, 10-year goals, 20-year goals, right? There's a huge opportunity, but it requires you to think with an abundance mindset. So here's how you do this. I encourage you to pause the short term. That can be hard, right? Again, I've been an executive director of a nonprofit. I understand. Pause the short term, plan for the long term, and that allows you to be purposeful in everything, because we want to pursue resilience and we want to pursue growth. And we want to be around not just for the next 6 months, but we want to be around for decades. And this is how you do that, is getting to have financial sustainability. Pause the short term, plan for the long term, be purposeful in everything. We believe that nonprofits could create an additional $5 billion each year simply by changing their financial practices. That's not fundraising more. That is literally taking what you already have, building intentionality around that, and just managing what you already have differently. Imagine the ripple effect and the impact that has on our communities if we just choose to spend as much time managing what we have and planning for the future as we do fundraising for it. So, 3 financial practices for a sustainable nonprofit, right? Don't just raise money, you have to manage it. Stewardship is what leads to financial resilience. Number 2, ask for asset donations, right? Over 5 years, you can grow your giving by 55%. That's the data. That's amazing. And lastly, have an abundance mindset. Trust the vision that you have. Take time to pause and plan for that and put all the strategies that you need to have in place where that abundant vision and the money that you need to make that happen can come to fruition. This is what high-capacity donors want you to be thinking about. If you're going to pursue asset gifts and you want to pursue the bigger bucket, they want to know, are you going to be around in 5 years? Do you know how to financially manage your funds? Are you planning? Do you have a reserve fund? Right? These are not things that we should be scared of, but we should be educated and intentional about the plan we have and ready to articulate that to our donors to help us move the mission forward. All right, that's what we have for today. So thank you.